For more than 50 years, Canada fueled America's economy, quietly supplying the oil and gas that powered industries, kept fuel prices stable, and held the backbone of American energy security together. But that era is over. In a stunning and deliberate move, Canada has just cut off $103.3 billion worth of oil exports to the United States and rerouted every drop to Europe and China. Washington never saw it coming, and the fallout is already spiraling. Washington thought it held all the cards. For decades, the belief inside the halls of American power was simple. How did this betrayal happen? Why did Canada turn its back? And can America recover before it's too late? What's happening? Canada needed the United States more than the United States needed Canada. It was an energy arrangement that appeared bulletproof. The United States offered the world's largest and most lucrative oil market. Canada supplied the fuel. It seemed like a relationship too big to fail, but that belief proved to be America's greatest miscalculation. The seeds of this breakup were planted years ago when Washington imposed aggressive tariffs and trade barriers on Canadian exports. Not just energy, but lumber, steel, dairy, and beyond. What started as a political flex, aimed at protecting American industries and projecting strength on the global stage, soon escalated into a full-scale trade war. And while American leaders dismissed Canada's retaliatory warnings as empty threats, Ottawa was quietly preparing for the unthinkable. Canada's frustration simmered behind diplomatic smiles and hollow statements of friendship. Every new tariff, every blocked trade negotiation chipped away at decades of cooperation. Canadian officials warned again and again that if the economic bullying continued, they would be forced to seek new partners. But Washington wasn't listening. The assumption remained that geography, infrastructure, and history guaranteed Canada's loyalty. That assumption was dead wrong. The final blow came when Washington doubled down on its trade war strategy, imposing tariffs so severe that they threatened entire sectors of Canada's economy. Ottawa realized there was no future in depending on an unstable and unpredictable partner. The government accelerated its diversification strategy, quietly signing long-term energy agreements with Europe and Asia. By the time Washington noticed, it was too late. Canada's energy future no longer pointed south. It was now locked into contracts that would reshape the global energy market and leave the United States scrambling to recover. But the shock in Washington was nothing compared to the surprise waiting across the Atlantic. Europe had pulled off a masterstroke, and America never saw it coming. If you're still here, you're clearly one of the few who actually cares about what's really happening behind the headlines. So do me a favor, go ahead and hit that like button and make sure you're subscribed. Europe's energy jackpot. Even Europe could not believe the deal they secured. While Washington remained distracted by internal political battles and foreign policy blunders, European leaders were quietly negotiating a historic energy partnership with Canada, one that would redirect billions of dollars of oil and natural gas away from the United States. For years, Europe had struggled to replace its energy dependency on Russia. Sanctions, supply disruptions, and the fallout from geopolitical conflicts had left European economies vulnerable. Canada's decision to walk away from the American market opened a door the European Union had been desperate to walk through. Behind closed doors, diplomats and energy executives from Germany, France, and the Netherlands fast-tracked negotiations with Canadian officials. Billions of dollars flowed into infrastructure projects, pipeline expansions, and liquefied natural gas terminals, all designed to transport Canadian energy across the Atlantic. For Europe, it was more than just an economic win. It was a geopolitical triumph. By locking in long-term deals with Canada, the European Union secured not only stable energy prices, but also political leverage against Washington. No longer would Europe be forced to rely on volatile suppliers from the Middle East, or endure American pressure over energy policy. The scope of these agreements stunned observers. Canada wasn't just sending excess capacity to Europe. It was diverting shipments that had, for decades, been earmarked for American refineries. This wasn't a side deal. It was a total realignment. As European tankers filled up with Canadian crude, the United States watched helplessly. But while diplomats scrambled to understand what had happened, American consumers were about to face the first real consequence. And it would hit them exactly where it hurt the most: America's oil dependency collapse. Think gas prices are high now? This is only the beginning. The loss of Canadian oil has created an energy vacuum that American refineries cannot easily fill. For decades, Canadian crude flowed south, stabilizing U.S. fuel markets and keeping prices manageable. That pipeline of supply is now gone, and the impact is immediate. Gasoline prices began climbing within weeks of Canada's announcement. Diesel costs surged, hammering the trucking industry and raising transportation costs nationwide. Jet fuel prices spiked, forcing airlines to increase ticket prices and scale back routes. For American consumers, it's a nightmare scenario. The average family is already struggling with inflation, stagnant wages, and rising costs of living. The sudden spike in fuel prices is adding hundreds of dollars a month to household expenses. Commutes are more expensive. Grocery bills are climbing. Small businesses that rely on affordable fuel are watching their margins evaporate. The worst part: this is not a temporary shock. American energy infrastructure was built around a steady flow of Canadian crude. Finding alternative suppliers will take years, and every day without that supply chain in place will push prices higher. Behind closed doors, government officials are scrambling for a solution. But no matter what they do next, the damage is done. The betrayal is complete. And the consequences are just beginning. Because what happens next? Washington's desperate attempt to reverse this disaster will only make things worse. Washington's panic mode. How DC tried to undo the crisis. The moment Canada finalized its $103.3 billion energy deal with Europe, Washington erupted into chaos. It was as if the political establishment had suddenly woken up to a disaster of its own making. Inside the White House, urgent meetings were called at midnight. Senior advisors scrambled to draft memos, while energy executives, foreign diplomats, and trade negotiators were summoned for emergency talks. The phones in the Department of Energy never stopped ringing. Behind closed doors, panic replaced the arrogance that had defined America's energy policy for decades. For years, the assumption in Washington was simple: Canada would always be there. But that assumption collapsed overnight, and now the United States was facing an economic time bomb without a blueprint to defuse it. The initial reaction was pure denial. Lawmakers pointed fingers at one another, blaming political rivals for the collapse. Trade officials insisted they could renegotiate terms, while lobbyists warned that the damage was already irreversible. Every department had a different solution, and none of them agreed on who was responsible. Congressional hearings became shouting matches. One side demanded immediate tariff rollbacks to appease Canada. The other side accused Canadian officials of betrayal and called for retaliatory sanctions. In the middle of it all, the president's approval ratings plummeted as headlines screamed about the energy betrayal. Behind the scenes, foreign diplomats tried to mediate, but Canada remained firm. It was done with American trade bullying, and the ink on the European contracts was already dry. As emergency policies were drafted and debated, a grim realization set in. There was no quick fix. The infrastructure, the pipelines, and the trade relationships that had tied Canadian energy to the United States were crumbling. Even if the White House reversed every tariff tomorrow, the market had already moved on. And just when policymakers thought the crisis couldn't get worse, the economic shock began to hit America's industrial heartland. But before Washington could get its act together, the factories started falling like dominoes. The factory shutdown nightmare. It began with a single factory closure in Michigan, a steel plant that had weathered recessions, trade wars, and automation, but could not survive the skyrocketing cost of energy. That closure was the first of many. Within weeks, auto plants, metalworks, and electronics factories across the country announced layoffs and production cuts. The manufacturing backbone of America was crumbling under the weight of energy prices that no company could absorb. For decades, these industries thrived on cheap, stable energy from Canada. It was the silent engine behind American prosperity, keeping costs low and jobs secure. But now, without Canadian oil and hydroelectric power, factories were facing an entirely different reality. Contracts with new suppliers from the Middle East and South America came at a premium, and domestic energy production was years away from filling the gap. Every barrel of oil, every kilowatt of power cost more, and companies were passing those costs onto their workers. Steelworkers, machinists, and assembly line employees bore the brunt of the collapse. Union leaders pleaded for federal intervention, but Washington was paralyzed. In Detroit, Ford and General Motors halted production lines, citing unaffordable electricity rates. In Pittsburgh, steel furnaces went cold for the first time in decades. In Ohio and Illinois, factory towns watched helplessly as thousands of workers were laid off. Entire communities pushed to the brink of economic ruin. This wasn't a temporary downturn. It was a structural collapse. Without affordable energy, America's manufacturing edge was vanishing, and with it, the livelihoods of millions. Small businesses that supplied these factories, machine shops, logistics firms, parts manufacturers, were next in line to fall. The ripple effect spread faster than anyone in Washington had anticipated. And just when workers thought they had hit rock bottom, the lights started going out. The power grid collapse. For most Americans, the loss of Canadian oil was bad enough, but few realized that their electricity also depended on Canada, until the blackouts began. In the northeastern United States, hydroelectric power from Canada had long been a stabilizing force, keeping electricity rates low and the grid reliable. Now that lifeline was severed. In cities like New York, Boston, and Buffalo, rolling blackouts became the new normal. As winter approached, demand surged while supply shrank. Power grids, already under strain from aging infrastructure and increased consumption, buckled under the pressure. Utility companies scrambled to find alternative sources, but they were forced to pay exorbitant rates on the spot market, and those costs were immediately passed to consumers. It wasn't just big cities that suffered. Rural communities across Michigan, Vermont, and Pennsylvania faced week-long outages, with no clear timeline for restoration. Hospitals ran on backup generators. Small businesses closed early to avoid operating in the dark. Families were forced to choose between heating their homes or putting food on the table. Federal officials warned that this was only the beginning. Rebuilding power infrastructure to replace Canadian hydro would take years and billions of dollars, money that neither the government nor the private sector had readily available. As blackouts became a weekly occurrence, public outrage grew louder. Protests erupted in state capitals, demanding answers Washington could not give. But as America struggled to keep the lights on, another economic disaster was quietly brewing in every grocery store, department store, and online checkout cart. The American consumer's breaking point. While factories closed and blackouts spread, millions of American families faced a more personal, crushing reality. The cost of everything was skyrocketing. It wasn't just at the gas pump. It was on every grocery receipt, every airline ticket, every online order. The loss of Canadian energy wasn't just an industrial crisis. It was a consumer nightmare. The reason was simple but devastating. Without cheap Canadian energy, transportation costs exploded. Diesel prices for freight trucks surged. Air cargo rates doubled. Food processors, retailers, and e-commerce giants all passed those costs directly to customers. A gallon of milk that once cost $3 now costs $5. A plane ticket that used to be $200 jumped to $350. The price of electronics, clothing, and home goods followed the same trend. For working-class families already struggling with inflation, this was the breaking point. Essentials became luxuries. Credit card debt soared as people tried to keep up. Small businesses, caught between higher operating costs and shrinking customer budgets began to fold. Community grocery stores, family-run diners, and local hardware shops shut their doors as foot traffic dried up. The middle class was being squeezed from all sides. Savings accounts vanished. Mortgage payments fell behind. The American dream, built on the promise of affordable goods, stable jobs, and a secure home, was slipping away. Washington's political battles and corporate debates meant nothing to the millions facing empty wallets and shuttered businesses. And as the economic pain deepened, the American public began demanding something more than empty promises. Canada's energy empire. Canada's rise to global energy dominance did not happen overnight, but when it finally arrived, it felt like the entire world blinked and missed it. While Washington was tangled in political infighting and trade wars, Ottawa was quietly and systematically building an energy empire that would reshape the global economy. By the time the United States realized what had happened, it was too late. Canada had moved from being America's dependable, unassuming supplier to one of the world's most powerful and independent energy exporters. And the secret behind Canada's meteoric rise? Strategic infrastructure investments, relentless diversification, and a long-term vision that outmaneuvered both Washington and Beijing. For decades, Canada's energy exports were seen merely as an extension of the American economy. Pipelines flowed south, refineries hummed across the border, and policymakers in Washington assumed that this relationship was permanent. But Canada had other plans. As trade tensions escalated and American tariffs tightened around Canadian industries, Ottawa began pouring billions of dollars into energy infrastructure projects designed not to serve the United States, but to bypass it entirely. The Trans Mountain Expansion project, long delayed by environmental debates and political disputes, suddenly gained unstoppable momentum. New liquefied natural gas terminals on Canada's west coast were fast-tracked, designed to open the floodgates for exports to Asia and Europe. At the same time, Canada invested heavily in expanding its rail and port systems, ensuring that no future bottleneck would leave its energy trapped within North America. Billions flowed into renewable energy projects as well. Hydroelectric, wind, and solar initiatives that positioned Canada not only as an oil and gas powerhouse, but as a leader in the next-generation energy economy. These moves were not reactive. They were calculated, deliberate, and ruthless. Canada was done being America's backdoor fuel tank. It was building an empire. By the time these investments matured, the results were undeniable. Europe, desperate to replace Russian energy supplies, looked west, not to the United States, but to Canada. Asian markets, including China and India, signed multi-decade supply contracts, ensuring that their factories and economies would run on Canadian resources. Canada's energy exports soared beyond expectations, and with every new deal signed, America's leverage diminished. What had once been a quiet neighbor was now a global energy superpower. But Canada's rise wasn't the end of the story. It was only the beginning, because across the Atlantic, another player had quietly secured an even bigger victory while Washington was too distracted to notice. Europe's secret victory, how it outplayed the US in the energy war. While Washington was scrambling to react to Canada's energy pivot, Europe was playing a much smarter game. Behind closed doors, European leaders had been watching the US-Canada relationship crumble, and they wasted no time turning that chaos into an opportunity. What appeared to American officials as a simple energy shift was, in reality, a masterclass in European diplomacy and strategy. And when the deals were finally announced, even the European Union's own citizens were shocked by how skillfully their leaders had outmaneuvered Washington. The European Union moved quickly and decisively the moment Canada signaled its willingness to diversify away from the United States. Brussels sent trade envoys, negotiators, and energy experts across the Atlantic. They offered favorable terms, long-term contracts, and infrastructure investments. Everything Washington had failed to offer when Canada first started looking for new partners. These negotiations weren't publicized. European leaders understood that the longer Washington remained oblivious, the more leverage they could extract. By the time American officials noticed, it was too late. The European Union had locked in multi-decade supply contracts worth tens of billions of dollars. These weren't one-off deals. They were structural, binding, and designed to make Europe Canada's primary energy customer for the next half-century. Ports in France, Germany, and the Netherlands were upgraded to receive Canadian liquefied natural gas. Oil refineries across southern Europe retooled to process Canadian crude. Billions in European capital flowed into Canadian infrastructure, ensuring that this alliance was cemented for generations. For the United States, this was a devastating blow. Washington had assumed that if Canada ever moved away, it would pivot to Asia first. But it had never imagined that its closest economic rival, the European Union, would become the primary beneficiary. The transatlantic energy relationship that once anchored American global power was now shattered. And the worst part? Washington didn't even realize it had lost the game until the contracts were signed. But Europe's diplomatic coup had far-reaching consequences beyond the energy market, because when America's allies stop depending on American energy, something much bigger collapses. America's global leverage. America's lost leverage. For more than 75 years, energy dominance had been the silent pillar of American global power, from post-World War II reconstruction to Cold War politics and beyond. The United States maintained its position at the top of the world order by controlling energy flows. When allies needed oil, Washington provided it. When adversaries tried to disrupt global markets, Washington stabilized them. That unspoken authority shaped diplomatic alliances, trade agreements, and military strategy for generations. But that leverage is now gone. The loss of Canadian energy exports to the United States did more than disrupt fuel supplies. It dismantled a key source of American influence. When Europe no longer relies on American or North American energy, Washington's bargaining power evaporates. And when global partners can source stable, affordable fuel from Canada without American involvement, they have little reason to bend to Washington's will. The consequences were immediate. Diplomatic meetings that once ended with American demands now ended with European indifference. Trade negotiations stalled as foreign leaders recognized that Washington no longer controlled the energy lifeline. Defense partnerships weakened as countries questioned whether they needed to rely on American security guarantees when their economies were no longer energy dependent on the United States. Even more dangerous was the ripple effect across Asia and the Middle East. China, India, and other major economies realized that they could now negotiate directly with Canada or the European Union, cutting out the United States entirely. For the first time in modern history, America's position as the gatekeeper of global energy had crumbled, and with it, so did Washington's ability to shape the global economy. But the real shock was yet to come, because while politicians argued and diplomats scrambled, Wall Street was about to experience a meltdown unlike anything since 2008. Wall Street meltdown. The energy crisis triggered by Canada's pivot was not just a geopolitical disaster, it was a financial earthquake. As soon as news broke that Canada's $103.3 billion in oil and gas exports were no longer heading south, the markets reacted violently. Oil futures spiked overnight. Refinery stocks plunged. Energy-dependent industries saw their valuations collapse in real time. But the real panic didn't hit until institutional investors realized that this wasn't a short-term disruption. This was structural. The one energy relationship Wall Street had assumed would never break. The Canada-US oil alliance was over. Pension funds, hedge funds, and mutual funds scrambled to unwind positions tied to American energy infrastructure. Billions were wiped from energy sector portfolios in a matter of days. The shockwaves spread quickly. Airlines, trucking companies, and manufacturing stocks plummeted as analysts recalculated the cost of fuel and production. Consumer goods companies issued profit warnings. Small-cap stocks with exposure to American industrial markets cratered. The broader stock market, already fragile from inflation and interest rate pressures, tumbled into correction territory. By the end of the quarter, trillions in market value had vanished. Retirement accounts were decimated. The Dow Jones Industrial Average recorded its steepest monthly decline since the 2008 financial crisis. And all because Washington had failed to see what was coming. But the market fallout wasn't just economic, it was psychological. For decades, investors had assumed that American energy security was untouchable. That assumption was now shattered, and as Wall Street scrambled to contain the damage, the rest of the world was already preparing for the next phase of this crisis. Because America's financial collapse was only the beginning, the global domino effect was about to begin. Canada's energy empire. Canada did not just walk away from the United States, it walked into a position of global dominance. While Washington scrambled to respond to the loss of $103.3 billion worth of Canadian oil and gas exports, Canada was executing a long-term strategy that most American policymakers never saw coming. This shift was not reactive. It was not emotional. It was methodical, calculated, and backed by decades of investment. For years, Canada had quietly been laying the groundwork to reduce its dependence on the United States. It poured billions into pipeline expansions, liquefied natural gas terminals, and renewable energy infrastructure. New trade routes were established, connecting Canadian resources directly to Europe and Asia. By the time the United States realized what had happened, Canada had already become the indispensable energy partner for the European Union and large Asian economies like China and India. What made Canada's rise so effective was its political unity. Unlike Washington, where partisan battles paralyzed energy policy, Canada worked seamlessly across party lines to secure its energy future. Federal and provincial governments collaborated on infrastructure projects that ensured Canadian oil, gas, hydro, and even renewable energy flowed to the highest bidder, no longer limited by geography or old alliances. European nations, desperate for alternatives after cutting ties with Russian energy, eagerly signed decades-long contracts with Canadian companies. Asian economies, racing to fuel their industrial growth, locked in massive supply agreements. Canada, once dismissed as a secondary player in the global energy market, had become the cornerstone of the world's new energy order. And just as America began to understand the scope of its loss, another superpower stepped in to exploit the chaos. China's energy coup. China saw the US-Canada energy fallout not as a crisis, but as an opportunity. As Washington scrambled to reverse its trade blunders and repair relations with its northern neighbor, Beijing wasted no time stepping into the vacuum. Behind closed doors, Chinese officials worked around the clock to secure favorable energy contracts with Canada, effectively locking the United States out of one of its most reliable supply chains. Beijing's strategy was clear and ruthless. It offered better terms, guaranteed long-term partnerships, and massive infrastructure investments in Canadian ports and export terminals. These deals were not short-term band-aids. They were designed to secure China's energy security for decades. With each agreement signed, China's grip on global energy markets grew tighter, while America's influence slipped further away. But China did not stop at Canada. It used America's collapse to expand its energy empire worldwide. Deals were brokered with Russia, Middle Eastern nations, and African producers, diversifying China's energy portfolio and insulating it from Western sanctions. While Washington debated policy options and scrambled for solutions, Beijing quietly rewrote the global energy map. The consequences of this shift extended far beyond oil and gas. China's manufacturing sector thrived on cheap, reliable energy, allowing it to outcompete American industries. As China's energy security strengthened, so too did its geopolitical power. The United States was no longer the world's energy kingmaker. That title now belonged to China. That's it for today's breakdown. If you made it this far, drop a comment and let me know your take. And don't forget to hit subscribe so you never miss what's really happening behind the headlines.